Okay, everybody, this is Patrick Zielbauer from Infinity Futures. It is Thursday, March 22nd, 3:30 p.m. Central Time. Thanks, everybody, for coming to the event today. Before we hand it over to Scott, I'm going to do some risk stuff and do a little bit of an introduction, so please feel free to ask questions if you have any. Trading futures, options on futures, and retail off-exchange foreign currency transactions, that means Forex, involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you. In light of your circumstances, knowledge, and financial resources, you may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, only fund a futures account with risk capital. That means money you can afford to lose without lengthening your retirement horizon or affecting your ability to maintain your lifestyle. All right, if you have any questions about where you fall on the risk capital curve, so to speak, and whether or not this type of trading in general is for you, please feel free to have a discussion with your representative in our office about that. We are certainly happy to discuss risk with you. We speak objectively when it comes to risk. There's no doubt about that. And we would be happy to have a discussion with you just to see if this is something you think you should pursue. Okay? So please, again, feel free to have a discussion with your representative in our office, whoever that may be, about risk. My name is Patrick Zielbauer. I'm an AP or associated person of Infinity Futures. I've been working here for almost 14 years. And in that time, Infinity has offered and supported all kinds of different trading platforms and data feeds and charting programs and systems and so on. And we are very, very lucky to have Scott from InvestiQuant here with us today. It has been a while since our last event with InvestiQuant. And I obviously will let him get into the meat of the presentation, but just to frame this, what is happening here with this integration between InvestiQuant and Infinity is InvestiQuant has designed, and I'm going to oversimplify this, and Scott will obviously get into the gritty details. InvestiQuant has designed systems that basically send Infinity instructions to execute trades. So for over a year now, we have been executing live trades at 7:20 in the morning Central Time for the interest rates and 8:30 in the morning Central Time for the indexes in giant allocation accounts allocating to tons and tons of different client accounts. And it is the technology is unbelievable. The trade execution is in the milliseconds. It's super fast. We have taken away a lot of the technology issues that tend to plague self-directed traders. So is this for you? Is this type of trading for you? That answer is very personal because it has a lot to do with risk capital structure. But if you feel like you want to participate in the futures market, that's criteria number one, that you maybe don't have the time or the discipline to deal with it yourself. Okay, that might be requirement number two. And you want something that is hands-off, meaning you're not turning it on and off every day. You're not logging in and changing stuff every day. You just want to let it go. That might be requirement number three. Then this might be something that is a good fit for you. I have a sense that, and I'm not certain of this, and Scott is not a vindictive character, but I'm guessing that there is going to be an air of vindication in Scott's presentation today, because Scott's claim, ever since we started doing these events last year, at the very beginning of last year, has been that their programs tend to perform better under periods of heightened volatility. Yet last year was a tough year for everybody, especially in the trading world, especially with volatility, the VIX at an all-time low. It was not easy. We had lots of conversations with people who wanted to maybe stop trading the programs, or just, they were making money in the stock market. So they're thinking, just why would I put my funds under the control of something that's not giving me a 20% net of fees return like my S&P index fund? There were lots of discussions that we had with people that just reminded me that traders in general have really short memories. And it just was shocking to me. But it was understandable because people were making money in the stock market. So sure enough, we did have some people drop out of the programs at the end of the year last year. But those people are unfortunately the ones who missed out on what turned out to be a very, very great start for InvestiQuant in 2018. And especially considering the volatility we've seen so far. So really a fantastic start to the new year. I'm really pleased with how things have gone. I think, and I don't quote me on this exactly, but I believe that anybody who started these programs, even if they had the worst timing at the beginning of last year, if they stuck with it, I think everybody would be up money right now. I'm not 100% sure of that, but I'm pretty sure that net of everything, even subscription fees, if you stuck with it, you're positive. There might be a few exceptions to that, but not many, especially not with the core and the plus programs, which have really, really had a phenomenal start to 2018. So I am thrilled to have Scott here to talk about InvestiQuant. It's been something I've been heavily involved with, ever since Scott, Scott and his team have been getting InvestiQuant going and integrated with Infinity. And on a more personal note, Scott and his chief tech, David, have been clients of mine personally at Infinity for over a decade. So there's a lot of history here. It's a very meaningful relationship for us, and we are really happy to have Scott there. So I know it's a little bit of a lengthy intro, but it's important information, I think, and I've been on the front lines of dealing with these customers and trades and the performance data and making sure everything's working properly for this entire year, and it just really has been nice to see something work out really well for people who've stuck with it at the beginning of this year. And of course, we can't predict the future. We don't know what will happen the rest of the year. Anything can happen. We know that. This is still trading, but nonetheless, it was nice to see a part of Scott's hypothesis be validated by the performance of the systems through a very tumultuous start to the year, as evidenced by this screen where you can see those charts in the background and many others similar that we've had in 2018. So thanks again, Scott, for making the time to do this. We really appreciate it. I'm going to hand the presentation over to you so you can take the screen. That's happening right now. I'm going to mute myself. And folks, if you have questions related to brokerage or how this works and so on, feel free to ask in the question box and I'll answer as best I can in that format. And obviously, if you want to have a discussion with us about this, we're happy to have that over the phone as well or via email. Thank you very much.
Thank you, Patrick, very much for the outstanding introduction. Can everyone hear me okay? If I can have a couple confirmations just to make sure, a sound check for me. All right. So let's power through this. I'm going to cover some things that I covered actually a number of months ago as well, but I'm going to do it very quickly because I recognize some of the names, or quite a few names here actually. So I know some of you are already clients, some have been thinking about it, and I just really want to get to the good stuff and the meat and the bones of what we do and help you determine if it could be a good fit for you or not. So I do welcome questions as we go along. I'm going to try to address them if they're related to the slide that I'm on at that time. Otherwise, I may pass on the question. And if I haven't answered your question by the very end of the presentation, please come back to it. I'll answer every question I can. And I'm even going to give you my email address. So if I don't get to it, you can still contact me directly. This is ultimately a game of education and understanding before you can be successful. So I'm really committed to that. We've been doing this a real long time. I've been helping traders and train traders and build systems for more than a decade. So I think Patrick's covered the risk disclosure here carefully, but the most important thing is futures trading is not for everyone. Systematic trading is not for everyone. And as you hear all the time, past performance may not be indicative of future performance. I'm going to pass on that. You can learn more about me on our website if interested, or shoot me an email. There's my email address there, scott@investiquant.com. So we're going to cover very quickly, how long will the volatility last? I have a magic crystal ball and I'm going to tell you. Actually, I don't, but I'll give you some ways to think about it and give you some research data. We'll talk about what worked and what didn't for me personally. In 2008, I'm obviously very biased towards my own experiences, but I'll share those with you briefly and help you think through automated strategies a little bit more, the pros and the cons, and then get into what I think is the good stuff. What we're doing here at InvestiQuant, we do have some really, really good technology, fantastic edges that we have built and refined and honed for years, and most importantly, it's what we do with our own capital. So we invite you to follow along and learn more. So how long is volatility going to last? Well, no one knows at all, right? The lead equities researcher in December from Goldman Sachs said that in their estimates, the greatest probability for 2018 would be more of the same, meaning volatility would remain very low through the majority, if not all, of 2018. And that was only 3 short months ago. And then you saw what happened there at the end of January when the market just exploded to the downside, right? Without even a single catalyst. Bad news event, economic event, anything. It just, everything conspired to, all of a sudden we had a gap down from all-time highs, and then we kept on trucking. This is a little bit dated slide. It bounced, and then we sold off again today, and looks like we may be working our way back to test those lows. The key point of this slide, though, this is from Rob, one of our co-founders. The 3 of us, myself, Rob, and David, are co-founders of the company, and then we are supported by a great group of other folks here as well. Rob shared this interesting research, and I think it's relevant. Only one time since 1993, out of 15 different events, has the 10-day average daily range, average true range, I should say, that's inclusive of gaps, has that 10-day average been more than double the yearly ATR average, meaning taking the daily range for 252 trading days. Only once has it exceeded that 2 to 1 and returned back to that very low level within a year. 14 out of 15 times volatility remained elevated. So that's a little bit of a mind twist to get your head around, but when you get an explosion of volatility like we've had, it's normally very indicative of a potential shift in sentiment, certainly a shift in volatility. And that's great news because it means it's probably going to be here at least a year based upon one stat. Now here's another way to look at it. I think I showed this at the last webinar last year that we did. When we get periods of volatility, and we've got lots of measures of it, but we have our own proprietary measure, and when it gets above that blue line, it has tended to stay above the blue line down here, elevated volatility, for years, going back to the dot-com rally and crash, the financial crisis of 2008, and then the rebound in 2009. See the extreme volatility. And then even as recently as late 2014 through middle of 2006, we had above average volatility. So those periods are normally fantastic times to be trading shorter time frames, especially intraday, and that's what we do. But the key thing is it can last for years, and it gives extra juice, extra fuel, if you will, for quality systems to leverage their edge, because the average opportunity is bigger, and you could still, while using similar or maybe a little bit bigger risk. So volatility is probably going to be around here for a while. I tend to ask people, in fact, I'll ask the group here real quickly, just I am curious, and I know I'm pretty bullish on volatility, but how many of who thinks that the next 5 years will be more volatile than the past 5 years? So just to keep people awake, put a Y in for yes or in for no. All right, I don't know. Goldman Sachs was just saying that maybe it'll return to lows very soon, and this is just a fake out. Anyone, how about people that think it won't be? Any no's out there? Don't worry, we're not going to pile in. I don't think I see a single no. So clearly, and we don't know, maybe the crowd is wrong here. The crowd sometimes is wrong, but volatility is probably going to be around here for a while. There's someone, big question marks. Yeah, we just don't know. So it's probably, I think many people think it's going to be a better environment than we had last year. As Patrick mentioned, it was a tough year. Without volatility, it's just more difficult to trade. Now, I've had success, and our systems have had success with normal volatility, and normal volatility is good too. It's just last year was such an extraordinary year, and I'll show you some of the results. We didn't do terribly. We just didn't do well either. It just, we were flat. So was a disappointing year, but man, volatility's back now, and I'm going to show you how we've done so far. It's just the beginning of the year. Anything can happen, but we'll talk more about that in a moment. So quickly, back to 2008. That's a long time ago. The reason I'm bringing it up is that there are some super smart people that believe we could have a very significant corrections. Corrections historically in the stock market have averaged, I've seen different numbers depending, I guess depends on how you calculate it, but 25 to 30% corrections are not unusual. It takes 10% to be considered a correction. So the financial crisis had a 56% drop from the equity highs in October of 2007 to the lows in March of 2009. 56%. I don't know if it's going to be that deep, but I can tell you I went through it, and it's a pretty amazing period of time. And I had a lot of success in some ways, and in other areas I didn't. Namely, discretionary trading. So going into 2008, I had been learning discretionary. Well, let me back up. I started off stumbling on the fact that opening gaps, when that means where the markets open relative to the prior day's close, are often mean reversion opportunities, counter trend trade opportunities, if you know what you're doing and you're careful and selective and you manage your risk. And I started doing a lot of research, and I got help from David, another one of our co-founders, who's a phenomenal developer and programmer and trader in his own right. And we built some models and started having some success. We built actually a system that I manually executed, and I'm going to show you how I did with that in a moment. However, I was also trading discretionary trading techniques from some of the biggest names in this industry. And I'm not going to name them. Some, not all of them, are still around because they've mastered the art of marketing. And they're probably decent traders as well. But what they taught didn't work for me. And here's proof. And sadly, Patrick can vouch. I don't know if he remembers or paid any attention to me back then. But I did not do well. And I don't know if I was the only one that didn't do well or not. I doubt it, because it was a very difficult environment. The markets were moving extraordinary amounts intraday, creating tremendous opportunity. The emotions were running hot. I was excited. I was having these occasional huge wins, followed by occasional huge losses. And as it turned out, I even felt like I was doing pretty good. I learned not to monitor my results day to day too closely, because I wanted to stay very neutral and objective. But I wasn't doing as well as I thought it was. And I actually went on a terrible drawdown, percentage-wise, I guess, for a small discretionary account. I had 3 winning months and 15 losing months. I'm not making that up. I'm not proud of it. I'm sure I'm underwhelming you, and you probably are thinking, well, shoot, you've got to be the worst trader on the planet. I'm really not. I've been trading for a number of years. I left the corporate world in 2003. All I had done was trade, and I'd had success. So, but once the markets started getting volatile, and I manually executed trades, trading using MACDs and RSIs, and looking for confluence and alignment of these techniques, and then manually pushing the button and going long or going short, it was just incredibly difficult. That's all I can say. The other side of the coin was, fortunately for me, was that I had success trading the opening gap, and had actually started a blog back in 2007 and had developed quite a following, posting my daily trading plan for the opening gap. And that blog was called, it was called The Gap Guy, and we turned it into a business called Master the Gap in February of 2008. So the whole point of Master the Gap was to post my trading plan with my target, my stop, and my entry. My entry was always a market order right at the open, so it was a very binary decision. And I would manually execute that trade, and then I would scale out. And I had a tremendous run. These are actual results. They came right out of my brokerage application that I was using my system trading with. It says 300 trades. This exact number was more like 100, because this is counting on average about 3 trades. I would scale in and then scale out. 63% win rate. You can see the S&P equity curve here going straight down, while my equity curve was going straight up. Now, there were some sharp drops in equity in this time, but this is from fall of 2007 through the bottom in 2009. Again, I just told you I'm not a great trader, but I'm very disciplined, and I'd created, with the help of David, we had created a tremendous system that traded the opening gap and adjusted risk and managed risk relative to the return very, very well. Probably the most impressive part here is my average trade was only an hour. I was barely exposed to the market at all, and my worst drawdown relative to the whole run-up was close to not quite 20%. So the message here, and this isn't what we are for anything. This was sort of the foundation, if you will, of and the underpinning of my passion that you can hopefully hear in my voice, which is I believe very strongly that most traders are better served with a systematic approach to trading. It's incredibly difficult in a bull market. You can buy the dips, the mid-morning dips and reversals, right, and do fairly well. But once market conditions change, most discretionary traders find that their techniques don't work nearly as well. I believe that's what folks have told me, and that's what I experienced on my own. It's sort of like junior varsity sports versus pro sports, right? A low vol, slow moving, grinding bull market, not that hard to trade on a discretionary basis. But once volatility kicks up, watch out. It's like going straight from junior varsity football to the NFL. So systematic trading is much better for many, if not most. I don't know the right number. You need to decide that for yourself if you're one of those people that it might be better suited for you. I don't know. But I can tell you some of the many benefits. Patrick's already mentioned a few of them. They help you get out of your own way. They get your emotions out of the way, and all the cognitive biases such as recency bias you've probably heard of, fear of loss, fear of missing out, you name it. You can turn your capital more frequently because you can trade more strategies in more markets. Right now, as you'll hear in just a moment, trading 5 different markets simultaneously, sometimes each day and sometimes literally simultaneously at the exact same time intraday. And I couldn't possibly do that with the optimal execution, if you will, unless I was doing it on an automated basis. You'll miss fewer trades. And I've heard this say many times of the years in the industry. If you want to be there for the good times, you got to be there all the time. You can diversify your trading capital efforts. That's probably one of the biggest benefits, because there were times when, on a discretionary basis, I have outperformed my systematic trading. I kept a journal, and with our clients, many clients know this, for 6 years, I tried to outperform my system with discretionary trading, and I only outperformed it twice. So again, I have had some periods of success with discretionary trading. The worst I ever did was when the markets were the most volatile. And last but not least, frees up your time. You don't have to babysit your trades if you're using automated trading. So for whom is automated trading not appropriate? Obviously, I'm very biased. I think there's 2 situations that stand out to me, and there's probably others, and you feel free to chime in if you can think of some. If you are one of those people that you just have to have control and understanding of exactly what's going on with the trade and your capital, then this isn't going to work for you. It's going to drive you crazy. You're going to feel very uncomfortable. I'll admit I'm very close to being in that category. I've never licensed anyone else's system personally. That's not my style. I'm very, very hands-on. You could even say I have a little OCD in that regard. So it may not be for you. If you don't have enough capital to split, right? Maybe you don't want to trade you don't have enough capital to trade discretionary trading in one account and automated trading in another, and you haven't convinced yourself that you haven't decided whether discretionary trading is right for you or not, then we might not be a good fit for you right now. So I just ask that you don't blow up your account and you remember us if you hit some tough times. And I do hope if you're go down that path that it does work out for you, because some people do have good success. So I have powered through those slides. Let me open up to any questions, anything I've covered so far before I jump into our portfolios and a little bit more about our company. Any questions? I'm going to take a sip of water here. And okay, I don't see any. That's great. So let's get into the second half here super quickly. We are a combination of traders. We actually have myself, Dave, Matt, and Rob are traders. This is how we think of ourselves and what we do each day. But we also have technologists, developers that work for us either part-time, full-time, or on a contract basis. Same with data scientists. These are number crunchers. And we do, and I guess as traders, we consider ourselves market technicians as well. We are member-owned. A little bit unique part of our story is that Master the Gap grew very quickly from our success in 2008 and 2009 to the point that by 2014 I had multiple members, two specifically in back-to-back weeks, suggest that I add other markets and other techniques because they were having such great success. We just weren't trading enough. They wanted to turn their capital more, and I told them I'd take quite a bit of capital to do it right because I'd built a software technology before and didn't really want to divert my own capital to that type of initiative. And the client offered to provide some equity if I was willing to give up a little equity in the company, provide capital. I said, hold that thought. I had another gentleman tell me the same thing last week, and I went back to him and talked to them. Long story short, we raised quite a bit of capital from over 30 clients in a short amount of time. That's maybe the number one endorsement I've got of anything to tell you about me and us and what we do. Most of those clients I'd never even met face to face. They had just enjoyed success with our service and were interested in helping us grow. And we use that capital to not only add markets and some techniques, but we've evolved to using that capital to automate. That was the other part of our fundraising. Folks want us to automate the signals so that we could trade their capital for them, or and provide the technology to their broker, like Infinity does, to trade their capital for them in their accounts. So that's a little bit about who we are and what we do. Our portfolios are actually groups of algorithms. They're strategies, fully automated strategies that are adaptive in nature to the markets. They watch what's going on in the market in real time. They do execute in literally milliseconds. We monitor that very closely when a setup is attractive at the open based upon what's happened overnight, what happened yesterday, what happened the prior week and the prior weeks, and even prior, sometimes days, weeks, and months before. When those attractive opportunities are identified, they execute an electronic signal that goes to Infinity that routes that electronic signal on your behalf directly into your account, including exit orders as well. So it's literally hands-free. We call it our white glove service. You don't need to do anything. Patrick really does the heavy lifting, helping you and manage you. We also do quite a bit, as you can imagine, and we're here to support you as well. But that's what these automated portfolios are. We have 2 available. We did have a third one. We've actually had 4. We sold out. Our very first one was our smallest one, and then that's not listed here. And then the IQ base is sold out also. And then we've got the core and the plus. Sold out doesn't mean they were the best ones necessarily. In fact, a little bit counterintuitively, or if not very counterintuitively, the smaller ones have struggled the most with performance. And the reason for that, and they've done okay, but the reason for that is it's very difficult to identify what's going to work in a given year when it comes to strategies, right? There are market regimes, different levels of volatility, different levels of trend, momentum, and so on. And the smaller ones are a little bit hit or miss in terms of how they're going to perform in a given year. The bigger portfolios, those are the ones that have more signals, more strategies in them. They're more diversified. And because the risk reward is balanced and actually favors the larger gains, when you have more strategy in play that can take advantage of opportunities, you're more likely to catch some winners and have better performance. So this year has certainly proven that for us, and I'm going to get into that in a moment. Now, this funding capital, this is a screenshot from our website. There's an Infinity portal. You can see it right there, InvestiQuant.com/Infinity. The funded capital that is how much cash you would put into your account or trade with. And at the end of the presentation, before we open it up for questions, I'm going to turn it over to Patrick and let him talk about this whole concept of notional funding that I mentioned right here. It's very important. The beautiful thing is, and I'm not going to say anything else about it, is that you can use, if you understand the risk, you can actually trade with even more leverage than the capital you have in your account. You just have to understand the risk, okay? So let me talk about these two before I get to the portfolios, I promise you in the description of today's webinar, we talk about why IQ strategies love volatility, and they really do. First and foremost, they were designed to take advantage of normal to above average volatility, right? That's when the opportunities exist. It's literally that simple. If the daily range, since they're intraday strategies, is small, then the daily profit opportunity is small. If the daily range is normal, 20 points maybe in the ES is the historical average, then that's tremendous opportunity, because a point in the futures, the S&P futures at $50, that's $1,000 worth of opportunity. And normally it's a lot more than that, because the markets don't just go straight up or straight down. They'll wiggle and bounce around and cover lots of opportunity in a given day. So our strategies are designed to take advantage of that volatility. Volatility is indicative of fear and greed. Fear and greed are more predictable within the markets, or I should say the markets are more predictable, in my opinion and in our experience, when fear and greed is driving some of the action, because human emotions don't change. They never have and never will. Fear and greed are predictable. When you don't have fear and greed in the market, instead it's complacent, low vol, grinding market, it's sort of at the whim of whoever is moving the markets. I think there are algorithms that run by Wall Street that go hunting for stops, and you just don't want to be in the market on those days. Lastly, as I mentioned, reward to risk ratios are designed to favor the larger gains. That means we control the risk, we cap the risk. Even when the market volatility gets extremely high, there's a certain uncle point that we will max the risk out, but we won't necessarily max out the profit opportunity on a given strategy. So occasionally we will have some incredible outsized gains because we rode our winner. We got on the right side of a opening trend and we rode it. Like today would have been a great one to be short, right? We didn't capture it. In fact, the core did not take any trades today. The edge wasn't clear, and I think we had one bond trade in the plus, and it was a winner. So they're designed to take advantage of normal and above average volatility, and they don't always work, but they're engineered, we believe, in a way, and we've got a lot of experience doing this in a way that gives us an edge. So I see a couple of questions. I'm going to we'll hold this to the end if you don't mind, Ron and Lawrence. So the question is about observing before you commit and some of the financial metrics. So we'll just hold these questions, please. They're good ones. Core. So IQ core portfolio. It's approximately 20 signals. It's actually exactly 20 signals, but I think our description of the website says approximately 20 to give us a little wiggle room if we want to add one or subtract one. But we stay right at 20. We will not waver, though, on the maximum signals executed in day 10. So that's a max risk. So you can back into, and these are the markets we're trading, the S&P E-mini futures, NASDAQ futures, Dow futures, 10-year notes, and 30-year notes, okay? So these are very liquid markets, and you can determine your maximum daily risk. It's very rare for all 10 to trade in a day. I don't know what that number is off the top of my head, but I believe that the average when we do have signals triggering, it's about 3 or 4 strategies trading one contract each will trigger in any given day. In fact, you can see the actual metrics historically. Now, this is a asterisk because it includes hypothetical data, not just the live trading period. So if you look on the right, this is a fairly updated chart. It's a snapshot from our website. It's that InvestiQuant.com/infinity page that I mentioned before. You see live trading right here at the beginning of last year is that vertical line. and you can see how the core went sideways to down a little. It lost about 3% of its nominal value. Funding level can be more or less, that's up to you. So I have to do in terms of the nominal value. We have assigned to it as 200,000. You don't have to have 200,000. Again, that's called notional funding, and I'll talk about how I trade it in a moment. But it lost 3%, or about $6,000, inclusive of our fees. And that was pretty much all of our fees for that portfolio. We kept saying once volatility that this was not happy, we weren't happy with it, but it was historically incredibly low volatility, unprecedented low volatility. And once volatility returned, we liked our chances. That's the way I like to say it. And sure enough, you can see this is what's happened. Again, live trading since beginning of this year, actually since the beginning of February when volatility kicked. We're at all-time highs right now. This other yellow part here is the other period of elevated volatility. Now we were trading, I wasn't trading this exact portfolio because it just went live beginning of January. But remember I told you I've had my own fully automated trading system. I've traded for years. And as a proxy, because it's all trading the opening gap, which is the foundation of everything we do here, I had comparable performance to what is shown here. I have a 5-year third-party audited track record, and 2015 was just a tremendous year. So it's just the way these things are designed. They don't all work. You don't make money every year, as last year showed. But this was a period of volatility, and this color-coded area matches up. If you go back to, I don't remember what slide number it was one of the earliest slides where I showed the 3 different periods of elevated volatility going back since 1995. That was what happened during the last one, okay? Hopefully that makes sense. So the core on a monthly basis, we have it set to, you can view it on the website link, InvestiQuant.com/infinity, either by dollars or percent. Trading it in a dollar basis, it's up. This is technically hypothetical because we've got, it's based on the signals and assumed commissions and slippage, which will vary for everyone. Commissions vary. We do work with other brokers. Infinity's was our very first one that we've worked with them the longest. But the key here is that there's the 3.5% we lost last year, and we're off to a tremendous start this year. The yellow represents, again, the elevated volatility. Again, that period late 2014 through early 2016, and then once volatility went to extraordinarily low levels, it went basically sideways. So that is the core, and year to date, if you add that up, it's about $15,000 trading that strategy. Now this is not hypothetical. This is my actual brokerage statement from Infinity. Live, pulled it this morning, and we made this slide so you could see it, because I know sometimes that word hypothetical confuses people. It's actually trading my IRA, so I'm trading the core in my individual retirement account, and it started with about 100,000 in capital. I think the actual number was about 105,000 in capital, and it is up a little bit more than the number shown on the prior slide. But remember, this is my own account, so I don't charge myself fees. All right, so this is real stuff, and it's not just my account, as Patrick mentioned. He has, and we have many clients who are trading this exact same program, the core. There's nothing special about my version that I'm trading. I'm trading the exact same signal through Infinity into my account. So I'm eating my own cooking. In fact, I'm trading it in multiple units. Many members of our team, board of directors, shareholders, are trading these exact same strategies. That's the only thing we believe in that keeps our interests completely aligned with you. I do want to say this, and it's important. I used to sort of I don't know, get frustrated a little bit by all the disclaimers and that we had to follow because we're in a highly regulated industry. I've gotten to appreciate that much more these days. There are some characters in this industry that don't play by the rules, that and you can lose a lot of money if you are misled and don't understand the risk. So it's important you understand this is just a snapshot this year through today. You can see right there through March 21st. If I showed you my statement for last year, you would have seen that loss that I mentioned from last year. So there's no guarantee that the future is going to mimic what's happened this year. We just don't know, okay? So please consult your broker. Please consider the risk. Patrick and Infinity will give it to you straight. There are some risks. They're very manageable. I'm trading my IRA. I'm not doing that to impress you or show off or anything. It's the best, in my opinion, for me, but I know what's on the inside, okay? And I help build these things. It's worth the risk. In fact, in my mind, I shouldn't even say this, but I think what I do is safer than many other techniques for trading just simple equities and stocks. But that's why I do what I do. I don't trade any stocks at all or ETFs. You should certainly consult with Patrick or your Infinity broker before you consider trading your IRA, though, because that stakes are getting a little higher there as well. One of the note, this is notional funding. Again, Patrick's going to talk about that, as I mentioned at the end, why I have $100,000 worth of capital in a program that is sort of designed for $200,000. That's that nominal amount that confuses people sometimes. The Plus portfolio is bigger. It's got 50 strategies. It's got all the same ones from the core, plus some additional ones. So it has additional diversification, and it can trade about 3 times more signals in a given day, but because of the lack of correlation or lower correlation, we don't really think it's that much riskier. If anything, it may be less risky because it's more diversified. Trading the exact same markets and just trading more strategies. Just bottom line, it takes more funding capital to trade. And again, your broker can talk to you about that as well. The nominal investment amount on the Plus is $500,000. But again, you can use quite a bit less if you understand the risk of initial funding. And Patrick will talk to you about that in a few minutes. See a couple. Are there any limitations on IRA trading in the IQ core portfolio? Not from us. And it's not illegal or anything like that. You have to run it through a trust, like I use, you may have noticed on my broker statement, Ron, Millennium Trust. So you have to set that up, and it's a nominal fee to do that. Take you a week or two. There are others that do it as well for these trusts, but after that, you can certainly do it. And I've done it for years. And so in terms of metrics, if you log into InvestiQuant.com/infinity, you will see other metrics. We don't show the Sharpe ratio because the Sharpe really isn't a very good measure of a strategy. I know it's the traditional metric for financial strategies, but it penalizes you for upside volatility. It treats all volatility the same. So Sortino, as you mentioned, is a better measure. I don't know if we show Sortino or not. It's not something we get asked about from traders normally. We show MAR, ROMAD, return on max drawdown. We have something called IQ ROMAD. That is the hypothetical worst case scenario. What's the worst historical drawdown and as a percent of your starting capital? So it's an interesting metric. In fact, while we're talking about drawdowns, the most important thing I can tell you is that we've been through this very low volatility period. We show hypothetical data on our website going back 5 years. In fact, you can see it here, okay? These numbers down here are hypothetical. Remember, live trading started at the beginning of 2017. The worst drawdown during those times may be, in fact, I assume, will be less than the biggest drawdown we'll have in the future. Why? Because the volatility was, while it was more elevated, it wasn't like it was in 2008 or 2009. And you just always want to assume that volatility or drawdowns are going to be bigger in the future than in the past. So if you look at the worst drawdown, the metrics are shown on our website, I would double or triple it, seriously, because they just haven't endured, hypothetically or in live trading, significant drawdowns. Part of it's by design, but I can't guarantee you that we're not going to hit a tough stretch at some point. In fact, I can guarantee you we will hit a tough stretch at some point. So just expect it, and plan for it, and have an uncle point for where you will close the account or stop the trading. And that's the beautiful thing, is that all you have to do is pick up the phone or shoot an email to Patrick or the folks at Infinity, and they'll turn off your account within a day. Turn off the strategy. So you control your capital, and you control whether or not the strategy is trading it or not. Another question: how is the number of contracts traded calculated for each individual account? So the way it works is that we don't control the account, right? We're not registered. That's the broker's responsibility to send those signals. So there is a maximum number of strategies for each program that could trade in a given day, and it's very binary. So if you license the core, then you know it could trade up to 10 contracts in a given day, though normally it's 3 or 4 is the average margin. And you need to have enough margin to handle a worst case scenario of 10 strategies trading in a given day, and some buffer, of course, for a potential drawdown to avoid a margin call. Oh, and one other question: can we observe before committing live? Lawrence, you can go to that link, the InvestiQuant.com/infinity, and you can watch the results. They're updated every single evening. And as I just showed you, the hypothetical results that we're tracking are actually less than what I've showed in my own account. So they're very close. They are using estimated slippage, and that's probably the one variance, but we watch it closely and we adjust it. If it's, I think we've adjusted it down and adjusted it up to mirror our real tracking results. David in the back tracks slippage every single day, has been doing it for years. Let's see, other questions. Are your drawdowns calculated by using closed trades?
So Scott,
yes.
Scott, what he's talking about there is, this is one of the issues that we've run into with system trading in general, not with your program, but with other programs, is that, let's say someone is showing a return annually of 125%, and it's all audited real performance. Okay, great. But the problem is that most systems don't report unrealized drawdowns. So
right.
what he's saying is, like, if you go
enter
long,
trade.
Right, exactly. So you get, let's say you're in a position, you have $50,000 in your account, you get into a trade, and then the market goes $49,000 against you. All right, you're long blown out because we took you out of the position, right? There's no more money left.
Right.
And then all of a sudden, then the market comes all the way back, and it ends up being let's say that the trade comes all the way back and ends up being $1,000 winner.
Right.
So now you have $51,000 in your account that you didn't get to participate because you're long gone, but the system reports it as a winner.
That's right.
That's a huge.
That's
problem.
That's a huge problem in especially the multi-day swing trading strategies.
Right. Exactly.
Right. That may have taken overnight volatility. Our average. So first off, no, it doesn't account for that. That's another reason to buffer your drawdown amounts and trade these things with sufficient capital. The average stop size, and average is a dangerous word, right? But the average stop size on, say, let's say the average day is a 20-day average true range in the S&P, a 20-point average true range. Our stop size might be anywhere from 6 to 9 points that day, maximum. So we're just talking about one trade. So we're sort of like we're using a significant amount of capital, right? We're not talking about insignificant numbers, 100,000 plus, and trading several small individual strategies with. So it's not a very leveraged position normally, and it's just. I've never had that question before. It's just a non-issue for what we do. We're ultra conservative. We believe you need to come to your own conclusion on that, but. I don't know, Patrick, anything else you want to add there?
Well, with respect to the closed trades thing, I mean that is just not a problem here for me personally as a risk person because there's always a stop in place. So
Right.
we don't have a I've never encountered a situation with your program where the market went through where you would have had a stop because the stop would have stopped you out and then comes back and turns into a winner because you'd already be out of the trade because the stop is hit. So
Yeah,
it's
we're right.
not really, it's just not relevant to the way that these systems work. And that actually brings up a really interesting point. Again, this is maybe comes from the risk management background that I have, and that is that I'm despite the fact that IQ has started off really, really strong this year, I believe that someone who's an investor should actually be willing to accept a lower rate of return in exchange for the fact that they're not in the market as much. You're not in the market at nighttime. You're very rarely in trades that last the whole day. When you're in these programs, you might be in the trade for 5 minutes before you get stopped out or a profit target is hit. It happens frequently. So for someone who is concerned about risk and the likelihood of being in the market during a black swan event or some kind of outlier event, you're just less likely to experience that to the downside if you are not in the market as much. And with these programs, they're designed to be flat by the end of the day, and a lot of the trades are over within a few minutes or a couple of hours. So you're not some of the systems that you see out there. They're always in the market, and that can work out really great if you're on the right side of Brexit or the Trump election. But if you're on the wrong side of that, you could be in serious trouble, and that's just not a risk that we think takes. It's not a situation that we think takes into account the risk of ruin well enough. So that's one of the other reasons why I gravitate towards these programs, folks, is because they do get flat by the end of the day. They use a stop, and some of the trades are over fast.
Well said, Patrick. One more quick question, then I'm going to move on so we can get to the end, and then we can open up for questions. But Al asked, does it trade up, down, or sideways? So it depends on the market situation. We're trading generally off the open or near the open of the regular session. So if the market's gapping up and conditions are such that we believe it is likely to sell off, then we'll go short. Sometimes it gaps up and conditions are such we believe that the markets are likely to rally. And I say we believe, the systems, multiple systems validate every signal. And if the collective signal from at least 5 different systems we've built that measure trend, momentum, volatility, overbought, oversold, seasonality conditions, if collectively they say that the odds favor a directional move long or short, that's what determines whether or not it goes long or short. So it can be in either direction regardless of which way the market's gap and regardless of what state the market is in. They adapt to the market states and adjust accordingly. So just to summarize, they're intraday focused. You don't have that overnight risk. They are beyond theory. That doesn't make them infallible, but we've been trading these same concepts for a decade with our own capital. That's, again, all I can say there. Highly selective, as I mentioned, being validated by multiple lowly correlated trading systems. They are adaptive as market conditions change, meaning as volatility changes, as the trend and the direction of the markets change, the signals change themselves. They even adapt to their own performance. So we've had examples. In fact, there was one of them we were talking about recently that lost. It was our biggest loser in 2016. Of all of our strategies, it was down about 10%. And then last year, it made about 5%. But it only traded half the year. So it became much more selective. It recognized that it was not doing well in certain conditions and stopped as well as it used to, and to stop trading the signals. And that's sort of what's going on. That is what's going on each individual strategy that collectively goes into these portfolios. And then lastly, we've got limited inventory. We have sold out of, we used to have a mini that we talked about. The base, as we showed you before, was sold out. And those were the smaller portfolios, if you will. They haven't performed as well, though, as the core and the plus, again, from diversification. So we still have inventory available for core and plus. The reason we limit inventory, though, is to make sure that we don't destroy our edge. You can overtrade certain signals depending upon when they enter the market and or where their stops are located. So I wish we had unlimited capacity, but we don't. So that's just the way it works. And then last, as I mentioned, we eat our own cooking. So you can go to the InvestiQuant.com/infinity, choose your funding capital, and see what the hypothetical returns and risk would have been. And you can make a decision after talking perhaps to Patrick. If you have any questions, or giving us a shout. We can't give personal advice, but we can help you understand what the strategy is doing. And you can learn more about each of those individual portfolios. Just to talk pricing very briefly, and then I'll turn it over to Patrick to talk about notional funding. The core, as we said, has about 20 strategies. The plus has about 50. The license fee is basically a percentage of the capital. So it's set at just under $5,000. That's actually a discounted price. So normal pricing is $6,000. So we discounted that through the rest of the month on the core. That is deducted directly from, you can either pay with credit card on our website or just have it deducted directly from your account at Infinity. And that's a checkout option on our website. You can say, bill me, debit my account at Infinity. We'll invoice you via Infinity and transact, and they'll take it right out of your account if you wish. That's what this comment is down here. If you don't want to pay up front, you can do it on a deferred basis. Deferred basis means you pay nothing. So this is to, someone had a question, can we observe before committing live? So you're committed once you start on the deferred program to let them trade for a year, but you will only pay once we have achieved this target. And this is what, 60% more. So we make more, but we're not getting any money until the account has made those profits. Once that's debited, the rest of the gains in the account are yours for the remainder of the period. We're indifferent. Whichever one suits you better is absolutely fine by us. And again, this only goes through end of the month. So if you're interested, we'd love to answer your questions. If you have specific questions about portfolios and how they work, you can shoot an email to either me, Scott at InvestiQuant.com, or Matt at InvestiQuant.com. Matt's our operations and client support guru. He's involved in everything, and he can answer your questions and help you with any ordering issues, especially. And with that, let me see if there are questions on this. Yeah, this is an annual fee. So we don't offer monthly pricing. We used to offer monthly pricing, and what we found people did is that they were trying to time the market, and they were judging us based upon how we did in a given month. Folks, nobody knows how and when the markets are going to behave. All we do know is that in general, over a course of a year, there tends to be volatility enough to we believe, pay for and justify the fees that we charge. And if not, you won't return. So our interests are very aligned in that regard, but we're asking you to commit. We believe it's in your own best interest, by the way, and ours, of course, if we essentially ask you to commit for a year. And a couple more questions here. Well, actually, before I get to questions, let me get to Patrick because we're getting late here.
Okay. Scott,
instructions will be sent to you on how to order if you're interested. It's on the website. There you go. Notional funding, Patrick.
Right. Okay, good. So what I want to do, folks, is I'm going to take the screen back for a second because I want to go through an example using the data that Scott was showing a moment ago about his, the little blip from his statement from yesterday. So this is relevant to some of the questions that came up. And Scott, there were a bunch of questions that came up that were very related to execution and brokerage that I wanted to cover as well, if you don't mind, before I hand you the screen back. But this is what we saw in the slides earlier today. Okay, so funded capital, that's how much you actually put into the account. Okay, the nominal amount, that is the number that IQ is using to create its performance metrics. So you can see this is the core portfolio. They use 200,000 as the value to calculate the performance metrics. That does not mean you need to put $200,000 into your account. In fact, most of the people who are trading the core program have far less than $200,000 in their account. So the next question usually is, well, how much do I actually need? And we're gonna get to that. But I want you to go through these bullet points here real quick. Okay, so the metrics are based on 200 grand. This account that Scott is using here has roughly 100K in it. So what is the percentage return on whether or not you have $100,000 or $200,000 in your account? Well, if you have $200,000, this is about an 8% return, right? If you have $100,000, it's a 16% return, and if you had $50,000, it's a 32% return. All right, now this is a levered environment. It's a double-edged sword. Those numbers could be negative if Scott had incurred losses to this amount. Okay, -8, -16, -32. But the crux here is that you do not get different trades because you have less money in the account. You're just using more leverage. You get the same exact trades. If you put $100,000 in the account, you're going to get the same trades as if you had 200,000. All right, if you put 75,000, you're going to get the same trades as if you had 200,000. So you are simply going to see amplified performance to the upside or the downside because your account's going to be traded the same way that you're going to see basically as what InvestiQuant is showing on the website. All right, so you're getting the exact same trade. So there are implications of this, okay? There's good implications and there's bad implications, all right? The bad implications are if you start off with a very small amount of money and your timing just isn't great and you get involved right before a protracted or significant drawdown, you might reach a point where you're getting a phone call from us saying, hey, Mr. Jones, you need to add some money to the account in order to keep going. All right, thankfully, we have not had to do that yet. All right, but in theory, we might have to do that. So if you're trading with less money, you need to be prepared. We want to make sure you understand that if there's a big drawdown, you might need to add money to the account to keep the system going, okay, or stop. All right, the other positive implication is that because you can deposit less money, you can do something else with your money. So if you don't mind having 200,000 in the account, you just makes you feel good to put it in there knowing that you got plenty of cushion, then if you can afford it, put the whole amount in there and you probably don't have to pay as close attention. Okay, so there's good and bad related to adding a significant amount of money, matching the nominal value, or not doing that. And this has a lot to do with your personal tolerance for risk. Sometimes people ask us, okay, well, what number do you require? What is the minimum? We don't actually have a policy where we have a set minimum. As Scott mentioned earlier, this program trades a 10 lot max. I don't think I've ever seen it trade a 10 lot maximum. I think most, like Scott said, it's usually a 3, 4, maybe a 5 lot, but it could trade a 10 lot max. Many of you are our clients already. You already know what does Infinity need to trade a 10 lot trade? Not a lot, but because of the way these trades are done, which are in allocations, big blocks of trades going through, sometimes in the hundreds of contracts altogether throughout the day, that we have to manage risk on an aggregate level. We don't manage risk only on your account balance. So we can't be as flexible as we can be with a regular individual account that you're trading on your own, but we still are very flexible in that most programs that would be trading up to a 10 lot are going to require a lot more money than what we're requiring. So I would say that on the low end, maybe in the $50,000 range, you could trade the core program. I guess you could do it with a little bit less, but again, if there were a significant drawdown, which we fully expect eventually will happen, that you just need to be prepared. All right, so that is what we're getting at with the Plus program. The Plus program uses 500,000 as its number. I don't have anybody, not one customer who's in the Plus program who actually has $500,000 in their account. In fact, I have one customer who has like $350,000 or so who's actually trading 2 instances of the Plus program. So with the Plus program, if you were going to do it 1 instance of the Plus program, I would say on the low end, 100, maybe a little bit less if you were okay with the risk. But just again, I think the max drawdown historically on that program is in the $30-some thousand range. You just need to be prepared. We have to expect that the worst drawdowns ahead of us. So these are conversations we would like to have individually with you. Scott, as you mentioned, they're not in a position to talk with you specifically about your situation. We here at Infinity, we are. And we understand risk, and we will talk objectively about it. You know that. So if you're unsure, whether or not it's a fit or not, let us know your situation. We'll talk through the possibilities on a more personal level, and we can figure out if it's a match. That's what we do. So that's certainly something that we could do. There were a couple other questions, Scott, that I'd like to answer if you don't mind while I'm going through this. Is this okay?
Go for it.
Okay. All right. A couple things. So there are some questions about maximum risk. Okay. Rakesh, you were asking about this. So InvestiQuant has its own ATR-based stop protocol. So they're putting in stop orders automatically through their network, their connection to our back end. So they're working a stop order based on their own volition. We as a broker, yes, we have our own risk parameters. Again, many of you are clients here. You know we've got risk limits. We manage risk on this aggregate position just like we do on an individual account. So we have our own protocol in place. We don't rely on our risk limit as a stop loss. It's not guaranteed to work. We've never advertised it as such. But we do depend on whoever is placing the orders to manage their own risk. In this case, InvestiQuant is using stop orders, and they fully intend to use stop orders on every position that they place. So they're doing their own risk management, and then we're doing ours. Okay. Rakesh also asked another relevant question about who gets the best fills and what if you get a split fill, that sort of thing. We use an average pricing model that is as fair can be. The regulators like it, we like it, and basically what happens is when you buy, let's say that the system buys 200 contracts at a certain price and we get filled at 3 different prices, all those average prices are averaged. So everyone gets effectively the same average buy and the same average sell on the day. Nobody is favored. Nobody is favored. It's all done in one block, and this is the fairest possible way that it can be done. So there's no manual allocation of trades. This price was here, let's give it to that guy or that gal. It doesn't work like that. Okay, everything is averaged. All right. And then how many contracts are we trading across across the board? It's kind of a question to kind of see how big things are right now. All I can tell you is that it's there are hundreds of if a lot of the systems fire, we're trading hundreds and hundreds of contracts throughout the day, depending on which fire and which don't. So this is already nobody's a guinea pig here. I mean, this has been going on for a while. All right, I think that kind of covers, Scott, the stuff that I wanted to talk about. Do you want to take back over here and ask some or look for some more questions?
Sure.
Okay.
Yeah, we'll open up to questions. Any other questions now? We've covered a lot already, and I'm happy to stay here and answer further questions as well.
You can take the screen back if you want to put the URL up again. Oh, there was one other thing that came up earlier, and that is about the observation. So someone asked, can you observe before committing? So you're not going to get the signals. InvestiQuant's not going to give you the trade signals to follow along. You can look at their performance on their website. We have looked very closely so far at the performance data that IQ is posting. It very closely matches what we're showing in our live account. So that actually is a huge problem in our industry where the reality ends up being so different than the hypothetical. That is not an issue that we have had with InvestiQuant. They have been conservative with respect to the fills, the assumed slippage, commissions. Everything is very, very overshot in some cases. And that's what I mean. You could argue that maybe they're even shooting themselves in the foot a little bit by being so conservative, but it's the right way to do it. And we haven't had any issues where someone was looking at the data that they see on the site and it was grossly different than what we were seeing in the live accounts, save for a couple of like decimal point errors, early on. But the way that they're displaying the performance meets our standards, which are high. So
thank you, Patrick.
Yeah, sure. That was an important one. Does anybody else have any questions about the technology or how this would work? We one thing that does come up a lot when in the context of this discussion is that if you have a funded account with us, we can open up a sub account and you can fund it, and you can have these traded right alongside your existing account. So you're not going to see the trades in real time, but you're going to get a second page on your statement that shows the activity. All right, one other thing that you can do that's kind of cool, and this is going to depend more on your own trading, is we have some ability to do cross margining. So if you want to put some money in the InvestiQuant account, but you also want to be able to do some of your own trading, we might be able to let you do some of that trade off some of that money on your own as well, as long as you're not seeing huge swings in your intraday trading equity. So if you're the type of customer, who is seeing massive swings in your own trading, we're not going to let you use that money for yourself and for the InvestiQuant at the same time. But if you're only trading a couple of contracts, you're not seeing huge swings in your performance and stuff like that, you just want to be able to efficiently use your capital, we can work with you on that as well. Okay.
And there's another question here, Patrick, from a couple of questions relating to the strategies themselves in terms of how they work. The number of signals, Al, 20. You do not pick those. There's 20 that we've already pre-selected that we're trading with our own capital that we believe are appropriate for that program. So they're pre-selected. There's nothing for you to select. The algorithms determine what's going to trigger in a given day, and we've got a little intelligence there as well. But it's a maximum of 10. And then you can see, I thought we had win rate on here. If you go on the website, the average win rate off the top of my head tends to be in the low 60%. So we're not relying on a few outliers. That's not the way we trade. In fact, I do things a little differently than most. Again, I was trading my own capital for many years, and I found out psychologically I needed a higher win rate. I needed to be right more than 50-50, more than 50% of the time, because otherwise it got very difficult to trust my signals when they were only right 3 times out of 10. So just sort of a psychological issue. So historically, I've risked about the same or even a little more than my average gain on the trades. So any given time, they're going to win rates tend to vary probably between 55% and 65% for the portfolios overall. They are comprised of some different, some have higher win rates than that, and some have lower win rates than that. Questions about take a deferred option. What happens if I take a deferred option? There's not enough profits to fund, Agnes. That I don't think will happen, because the profits, as soon as it hits the target amount, so let's say you license the, let me get down here to the pricing, the core, and you do it on a deferred basis. When your account has grown $8,000 in profits from wins, we will invoice Infinity and Transact, asking them to debit your account that $8,000 after they verify, which they will and always do, that the gains were indeed legitimate and there.
Right. So Agnes, basically what happens is I get contacted by InvestiQuant saying, Patrick, can you or the appropriate representative verify that so-and-so has gained X amount in this time? And because they're tracking when you got into the portfolio, and they're tracking obviously their performance data. So we're doing the same thing. So we get that contact, we verify, and then we authorize the debiting of the account after that. And there's a document you would sign that gives us the authority to do that once that metric has been reached. So that's how that's been handled in the past. David, your question about portfolio performance affected by individual traders. I mean, we don't broadcast the signals anywhere in real time. At least I don't think, we certainly don't. Based on the liquidity of these markets and just the time we've been doing this, I do not believe that anybody can, take advantage of this before the signals fire. I mean, I don't even know when they're going to happen. I mean, I'm looking at the accounts, and right at let's say 720, when the interest rate contracts fire with the 10-year note and the 30-year bond, I'm sitting here looking at it, and at 720 comes and goes and nothing happens. There's no trades that day. And I know there's no trades that day for the interest rates. So sometimes I'll be looking at my platforms here. I've got them all running at the same time on a remote server, and I see 720, and all of a sudden I see all these positions come through. It just happens immediately. We don't know in advance that it's even going to happen. Okay.
Yeah, and I don't know how you'd even front run them, because often the best price is to delay the entry. It'd be illegal and unethical for us to do that. We would never do that. And it does come down to milliseconds and to the tick often on whether or not it's a valid signal. So we don't even know necessarily, that we go in and verify afterwards. Do you stop? Go ahead.
Sorry, let me take this one from Kevin. So Kevin said, Averages are suspect, but is there an average length of time it would take to reach 8,000 in a $50,000 account? So that's a loaded question because there is no assumption, Kevin, that will even happen. Okay, we want it to happen, but it really depends on the performance of the system. I mean, look at the beginning of this year so far. So if you I don't know, Scott, if you can go back to the slide that showed the performance data with the yellow highlights. Yeah. Okay. So like, there's the plus portfolio. That one's fine, or the core. That's fine too. So if you started at the beginning of the year, let's say Jan 1, you would have already paid InvestiQuant because they're up 319 bucks, 6,600 bucks, 8,159 bucks, right, in March. So that happened a lot faster than I thought it was going to happen. That's why I'm so happy about it, because I had a bunch of customers in this program for the last year who have been kind of flat. So
And that's exactly what Rakesh was asking. So that meant that no one got charged in 2017 on a deferred,
right.
And that, I believe, is correct. Pretty much everyone that bought last fall and even late spring did not get billed on the deferred.
A lot of them got billed, in the last
now.
couple of months, right? In the last month or so. So it really just depends on how good things are going. I mean, if they're going great, you might see a bill really fast, which would be a great problem for everybody to have. If things, hit the skids for a while, then you might not see a bill at all. That's the reality of it. So that's a great question. Agnes, am I personally trading the system? No, I'm not, and nor am I trading any futures contracts per my employment agreement. So it's important to make that distinction as well. Okay, there are conflicts of interest rules in our business. Okay. I think that about covers it so far. Does anybody have any questions that we may have missed so far? I mean, I can answer, more of the technical stuff and the brokerage related stuff, the risk stuff. Scott, he's the brains. So if you have questions related to that, he's your guy, and he's very accessible. I mean, I've had good feedback from people who have told me, it's been easy to get in contact with this team and get questions answered. And Matt, who Scott mentioned also, has been great in terms of his accessibility and his ability to communicate. So please feel free to talk with IQ's team directly about, any concerns that you have outside of how much money you should have in your account. That's not their business, nor is it their department at all. That's ours. Okay.
One more question, if I can, Patrick. Rakesh just asked, how often do you update the parameters of the program? So in general, I am very, very slow once we design a system to change anything. I have a personal rule that I won't change anything unless it's an error that I find inside of a given year. So we will review them year to year. I can tell you my original legacy gap trading system that was fully automated, went live in late 2011, did not make a single change to it until December before last, so December 2016, when I added a filter to avoid a certain type of trade around the holidays of December. So we're very slow to do that. Now, that was my legacy systems. That's my philosophy. The systems that you're getting here are much more sophisticated and advanced. So they're adaptive systems. It's multiple systems with rules that are designed to adapt to market conditions. So they're adapting every single day to what's generally working and has been working. So you don't really have to worry about that, nor do we. So we have not had to go in and make changes to those systems. They're using the same core systems that we've used for many years.
Excellent. And then just one final thing I want to mention too from our perspective. So just again to highlight who this type of program might be for. Okay, we talked about some of those things earlier about if you feel like you struggle with discipline, if you want to be able to participate, in this type of a market, but you just don't trust yourself with it yet, or you just haven't had success, then this might be a good fit if the capital requirement suits you. The general idea here is that these programs have a chance at least to make money when traditional investments are getting whacked. That's just the whole point of diversification. So if you can afford to split off some risk capital into an account like this that at least has a chance to win when all of your stocks and your pension or 401ks or all these things are taking a hit, then this is something that you might that you might be well aligned with. Just, there's no guarantees. We can't predict the future. I'm very excited and excitable because we have had a really fun start to the year, and it's always great to see that. And I feel, there's a degree of validation that I have felt so far from my clients who have had some success. So I feel good about that right now. But we don't want to be blinded either by euphoria. We want to be level-headed and reasonable. Always think defensively in your posture. And again, if you want to have a personal discussion about your situation and whether or not this is a good fit, we are absolutely happy to have that discussion with you. So please, again, feel free to come to me directly if you have questions. I'm happy to answer anything, on the Infinity side. And as far as InvestiQuant goes, you just go to investiquant.com/infinity, and you will see a little portal there that's sort of dedicated to us that has more information about the portfolios. In fact, you'll see a little details box you can push that will show you those metrics that you saw some screenshots of in Scott's slides. So you'll be able to do this funded capital exercise where you can see how much, how the performance figures would have worked based on X dollars in the account. And then you can also push the details button on that same page, which will show you more information like win rates and average winners, average losers, hypothetical performance data, and the like. All right. So thank you, Scott. Do you have anything else, or are we clear?
We're done. We're good. Yeah. Thank you for the opportunity, Patrick. Thank you all for listening.
Okay, thanks again, Scott, for taking the time to do that. Matt, thanks for answering those questions in the background. Much appreciated. Folks, really appreciate you sticking around. It's not the traditional type of event we do because this is obviously something very, very different, but we do appreciate your interest. And certainly if you would like to speak with us more about this, you can talk to your representative in our office or myself. We'll be happy to have that conversation. So thanks again. I'm going to take the screen back one more time and read some risk stuff. We will hopefully have the presentation up on YouTube within a couple of days at the most. So if you'd like to come back and watch a recording of it, you're certainly welcome to do that. All right, let me get the risk page back up here and we will wrap it up.
Thanks, Patrick. I'm out of here. Y'all take care.
Sure thing, Scott. Thank you. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Thank you, folks. Everybody have a great night. Thank you.